Again, I'll start it too.
Thank you all for being here. And unlike me, I hope you set the clock right. Good morning. In my garage. Thank you to our panelists who have literally come a long way to share their thoughts with us on the Indian investment scenario. So let me start off by a brief introduction. Roopa, who's here from India, from CRISIL, is the MD and CEO of CRISIL, where she has been for almost 20 years. CRISIL, as many of you would know, is India's largest credit rating agency. What Roopa just told me, that is only about a third of their business. They are very large in global advisory businesses as well. Kudva has other than her leadership of CRISIL, provides leadership to a lot of policy-making bodies and initiatives in India. And reflecting that, she was chosen as the Outstanding Woman Business Leader of the Year by CNBC last year. Our next panelist, Sid Yo, is one of our own. He's an HBS alum, graduated 2005. I just added 10 years. 2004. Sid, a Baker Scholar, which is one of our highest academic honors that graduating students receive, and also the president of his class at HBS. Sid is now the managing partner of the Xander Group, which is over $2 billion real estate investment company. He's also the founder and chairman of Virtuous Retail, which is a very large retail real estate company with about 10 million square feet of retail and entertainment centers all over India. Our third panelist, Merin, brings a very interesting perspective. Merin is with the US State Department and is currently the senior counsel for the Office of India Affairs. And Merin, as he was telling me last evening, does extremely fascinating work in helping US businesses interact with India and the other way around as well. So he coordinates the management of US-India relations through political affairs, business investments, international law, and various other things. And Merin spent a couple of years ago in Mumbai on the field, so to speak. So we will start with Merin. So we'll have a few introductory remarks by each of the panelists, and then we'll open it up to Q&A. So we'll start with Merin.
Thank you, first of all, to all of the students of Harvard University in creating this platform of tradition to illustrate India's meteoric growth in the global stage and looking to the future of the 21st century. Through India, the 21st century has now realized a new philosophy of calculus, integrating politics, economics, and diplomacy with the expansive depth and breadth of civilization spanning millennia of rich history. The internal strength of India directly correlates with its scope for international investment. She flourishes with unparalleled character in democracy, pluralism, religious equality, strength of constitution, and many, many other timeless principles, all of which resonate soundly with the bilateral relationship shared here in the United States. Investment is fundamentally scientific in structure, yet artistic in endeavor. And India's political economic landscape, in essence, defines this. The heart of investment in India flows by the pulse of the people-to-people connectivity through every village, town, city, and state, with the pillars of government, business, and public diplomacy as the foundations. Localization captures the inherent diversity of India and leverages it into a singular constant to balance all of the variables prerequisite in investment. This constant is the political power and the economic generator for all of India and extends well beyond New Delhi into cities beyond Mumbai, Calcutta, and Chennai even. Every state and city in India has come to the forefront of global gravity, not only capturing the independent entrepreneurial spirit of every Indian, but also delivering innovation that scales up the market capacity for investment. Consider this, 40% of national exports come from medium, small, and micro-sized enterprises. The Union Government of India has made great strides in economic reform, creating high potential for investment and partnership along a wide range of sectors, developing in the process increased resilience and inclusivity necessary for strong investment. The Government of India's focus on infrastructure, $1 trillion over the next 5 years, is indicative of this future vision. The Indian public's connectivity and ability to grasp new technologies is a game-changing dynamic in communication. And in addition, the insight of India, Inc. to brand locally, yet reach globally, is more than just promising. It's an idea whose time has come. For the first time since the era of economic liberalization, the level of rural consumption in India has grown faster than urban consumption, a testament to the value of localization. Additionally, projections indicate that India will be the third largest economy by 2025, and certain forecasts estimate will be the largest economy by 2050. From presidents of the United States to secretaries of state to US governors and mayors, we believe that state-to-state and city engagement is one of the most important foreign policy objectives to build upon the indispensable partnership with India and the next frontier of investment. The government protects and promotes the private sector. State-to-state and city engagement is a tripartite approach to investment, a combination of official, business, and cultural components necessary to sustain economic viability. This has been institutionalized by the United States and India, and in terms of coordination of international relationships, the local domain has now expanded globally, to which other countries are now pursuing the same options in India. Governors and chief ministers, mayors and senior executives in both countries have shifted paradigmatically into direct partnerships, investing heavily between respective states and cities, but also the people-to-people ties. Once a pioneer venture, this is now an institutional investment framework, soon projecting US-India two-way trade in goods and services to the stratosphere of over $100 billion. The historic trade mission of Maryland Governor Martin O'Malley in 2011, a 100-plus member delegation, approximated $60 million in business deals. Both ways, developed local economies, created jobs, and in addition, opened a new gateway for investment partnerships in India. In the same regard, governors from every region of the United States have now formed similar partnerships to help private sector focus on regions throughout India. And the chief ministers of India are equally as supportive and also frequent the United States to promote this. Cities are also finding a premier position in this equation, anchoring regional networks. Major US and Indian cities are linking with Tier 2 and Tier 3 cities to form regional connectivity linkages. They connect industrial, commercial, and knowledge corridors primed for international investment. Nearly 70 Tier 2 and Tier 3 cities in India have a population of over 1 million. The city of San Antonio had a very unique perspective. Recently, it established an economic dialogue with the city of Hyderabad, finding among other areas of partnership a mutual interest in shaping the Musi River to mirror the economic generator that is the Riverwalk. Urban management project coexistent with such economic deliverables is one example of which you can bridge the government and the business components of international investment. City-to-city engagement is prevalent all throughout India, and not just the major cities, looking to the ports, looking inland, in states that previously did not look outward. Now the chief ministers are making an extra effort to engage with us. Destinations of investment will always factor in general climate, the level of transparency, and the comparative ability to make deals. The precedent of comparative advantage, however, is not in the elemental transactions of investment. Rather, it is the commitment to converge internal values into a sustainable relationship. In other words, compounding the interests of mutually beneficial partnerships. In India, the commitment to invest is made in local roots. Investment is a partnership at the people-to-people level. The political economic landscape of India nurtures this. It would take lifetimes to explore all of India, and even in doing so, a perpetuity of unique dimensions continue to emerge. All of India, though, becomes one India when you reconcile local and global, ancient and modern, complexity and simplicity. As future world leaders, titans of commerce and industry, thinkers and pioneers, each of you will play a transformative role in the nature of international investment. Seek to advance the qualitative appreciation of investment over the quantitative determination. Global interdependency will force you to think through politics and economics under such context. And remind yourselves that the solution to the greatest challenges in investment lie always in the derivative of a singular constant. Thank you.
Thank you, Merin. Roopa?
Good morning, friends, and at the outset I'd like to thank the Harvard Business School for inviting me to speak at this conference. Very privileged, I think. I was asked to speak about what are the sectors and what are the asset classes that we see as emerging to be the next investment frontier in India. And that's what I'm going to talk about. But I think it would be useful to place place my comments against the wider context of what is happening as far as the economy is concerned. Because what you will see, I will talk about is how the investment opportunities that we see emerging are very closely linked to the economic growth of India and to the key drivers of that economic growth. But just stepping back a bit before that, on the politics of the country, in the context of which the whole economic activity and economic growth takes place, clearly our belief is that, compared to say 20, 25 years ago, the politics of the country has become increasingly fragmented. Coalition politics is the order of the day. And since coalition politics is the order of the day, it is a given, we believe, that decision-making will be slow. So it is said of India that for every 2 steps forward that we make, there's always 1 step backward, and we don't see that changing. Directionally, however, we believe that notwithstanding which political combination comes to power, we believe that directionally the commitment to economic reform is there no matter which the government. And I think if you look at the country over the last 15 years or so, you will indeed see that that is the case. Irrespective of whether it's the UPA government or the NDA government in power at the center, I think the direction of reform has remained pretty much forward and market-based and using a market-based approach. The other factor to highlight as far as the politics of the country is concerned is the role of the youth in politics. In the upcoming general elections in India, over 100 million first-time voters will exercise their franchise. It is no surprise, therefore, however, that in the last few weeks, you have seen several political parties upping their agenda as far as social media is concerned, for example. So I think a lot of the politics now is going to be driven by the desire to reach out to this 100 million first-time voters that are entering the electoral equations. So against this context of political background, what do we expect to be the growth scenario? We do expect growth rates to pick up from the 5% levels that they've reached in the fiscal year that has just gone by. Our medium-term forecast is 7 to 8% GDP growth, driven by the demographics and income profile, by the high savings and investment rate, and by the fact that social and physical infrastructure expenditure on these items has been more or less in line with GDP growth. So let me, there are various scenarios for growth, various combinations of favorable domestic factors and favorable global factors that are possible, right? And we forecast, if you have a combination of favorable domestic and global factors, you're looking at an 8.5% growth. But the highest probability that we have assigned is to a 7.5% growth scenario over a 5-year horizon, and that is predicated on favorable domestic factors and not so favorable global factors. And what really are these favorable domestic factors? I think the middle income group in India is set to triple by 2020 with greater discretionary spending power. Look at the yellow bar here. The middle income group, which was $4,000 US to $10,000 US in income, was only 11% of the population in 2009, and that we are forecasting will become 33% of the population by 2020. Think about what that does for discretionary spending. If you look at this chart, you can see that between 1980 and currently, the proportion of discretionary spending in household income has more than doubled from 22% to over 50%. And that has implications for a demand for a whole lot of goods and services, be it healthcare, be it automobiles, be it consumer durables, be it financial products like savings and investment products and the like. The second important driver of India's growth is the fact that after a very long time, in the last 6-7 years, our savings and investment rates have gone up to over 35% and are hovering between 35 and 37%. That again is a very big driver of the growth. Thirdly, the expenditure in physical infrastructure has kept pace with nominal GDP growth, and in fact, if you look at the expenditure on healthcare and education, it has outpaced nominal GDP growth, as the chart here shows. Of course, the bane of the fiscal situation is the fact that subsidies and welfare payments have significantly outstripped nominal GDP growth, but I think the fact that education, healthcare, and physical infrastructure have not lagged behind nominal GDP growth is a factor that is often overlooked. So we believe that, against all this, the overall outlook for economic growth over the medium term is fairly strong. Given these trends that we've talked about, what are going to be the exciting emerging asset classes? Clearly, infrastructure is one. I think Merin referred to 1 trillion infrastructure investments in his remark. We believe that the reality will be more in the region of 800 billion or so. And within infrastructure, we believe power, roads, railways, and urban, particularly urban, are key areas that are emerging for potential investment, particularly through the PPP route. Manufacturing. The government has stated its goal to raise manufacturing as a proportion of GDP from the 18% level it is at to about 25% through the new manufacturing policy. And we believe that the biggest engine of growth for the manufacturing sector in India is going to be the small and medium enterprises. SMEs, as Merin himself said in his remarks, account for about 40 to 60%, the estimates vary, of India's exports. They account for about 40% of industrial production and about 95% of the jobs created in India. So there's a huge push towards this SME sector, and we indeed as CRISIL have made huge investments in this sector in terms of improving transparency for SMEs in enabling them to access funding from the banking system. Given the fact that the demographics say that 50% of the population of India is below 25 years, given the fact that middle income group is rising and therefore discretionary spends are rising, we expect education, healthcare, real estate, and financial services to be attractive sectors. In financial services, we have a peculiar situation where the financial system, the demands of the financial system are to meet 3 very different needs of the population. The first need is to provide basic financial services for the vast majority of India's population. In India, 40% of the adult population does not have a bank account, and 80% of the population does not have access to loans. On the other hand, you have this growing middle class that I showed you in the chart earlier, whose need for new savings and investment products and consumer spending is growing. So the need for consumer loans, mutual funds, more sophisticated investment products, all of that is another demand from the financial system. And finally, the financial system also has to cater to the sophisticated corporate sector, which is going to demand services, products, etc., which are world-class, both to fund their own growth and to fund the growing needs of infrastructure. So that's in terms of the sectors which we believe are going to be attractive in India for a very long time to come, 10, 15 years. As far as asset classes are concerned, we believe the imperative for India is to develop its bond markets. If you have to have $800 billion to $1 trillion of investments in infrastructure, that is not going to happen unless you have a deep and a broad debt capital market in India. And consider this, for a country with a GDP of $1.7 trillion, you have a bond market which is just $250 billion. Quarterly trading volumes are about 30 to $40 billion. So there are only about 150 companies which access the bond markets every year in India. So these numbers, I believe, are pitifully low. And I believe that the imperatives for development of the bond markets and therefore opportunities in fixed income are going to be high if you look at the next 10 to 15 years. And finally, I think there is a larger need for greater retail participation in capital markets. Only 2.7% of the investments are from retail investors, both debt and equity. There have been certain steps which have been taken recently to augment or to increase retail participation in the capital markets, but let's see which direction they go in. And I think, I was also asked to talk about one example of how CRISIL, we as a firm, have tapped into these opportunities. And I would like to highlight the example of the SME sector. I think, till about 4 years ago, CRISIL was a company which rated 450 of the top corporates in India. We felt we said we are India's largest rating agency, but at the end of the day, if you have to make a difference to the markets and the economy in which you operate, you have to touch a larger population. And the way to touch a larger population was to go the SME way, because they account for about 26 million enterprises in India are SME enterprises. So what we did was very creative. We came up with a very simple credit assessment product in partnership with the government, which actually gave an incentive for the SMEs to get rated. We actually offered a rating product at less than $1,000 US as compared to the traditional rating product, which was anywhere from $10,000 US to over $100,000 US. So come up with an affordable product, come up with a simpler credit assessment product, and improve access to ratings, very similar to what the telecom companies did. The consequence of this is that today we have provided assessments to over 40,000 small and medium enterprises. 17 banks in India have announced interest rates concessions to these SMEs based on the ratings that we provide. And it is our assessment that these enterprises have saved $50 million by way of interest costs thanks to these ratings and the confidence that these ratings have inspired in the lenders. So this is a very small example of how creative approaches can help firms tap into the opportunities that the growth patterns and the growth drivers and the demographics of India are creating. Thank you very much for your attention.
So I'm going to stick to the panel and speak from here, if that's okay. Since I'm neither a diplomat nor an advisor or a risk assessor or a rating agency, I can afford to be politically incorrect, with all due respect, and focus on how to make money rather than what the opportunities that we keep hearing about in India are, with all respect to Roopa. Just to give you a brief background, I have been involved in India since 1993, so I saw the first wave of liberalization and of the opening up of the investment landscape. I used to work in India, I worked in India from 93 to about 99 for 6 years before moving to Singapore and then to Hong Kong in the first stage of regionalism that happened both from India and into India. It was Asia-led. and was the precursor to the globalization that we saw from, say, about 2002 onwards, which has happened over the last 10 years. How do you make money in India? You know, obviously, I'm not going to get into details. Roopa is absolutely right. On paper, it seems there are great opportunities in India. Merin is absolutely right. Sitting 10,000 miles away, it seems this is a large country, one of the largest economies in the world, growing rapidly, both in terms of population, in terms of demographics, in terms of urbanization, which are all going to be key drivers. But the honest truth is that most people who've invested in India have lost money. And that is not likely to change in the near future. And the reasons for that are structural. So while investment opportunities exist in India, the way that investors are forced to look at those opportunities and their experiences in India have been horrible. And that's to say the very least. So let's cut to the chase and forget about all of this positioning and sales talk. The fact is, India is a pariah in the investment markets right now. Most people do not want to invest in India. And of course, this has to be read in the context of what's happening in the global markets as well, where you know, growth stories have this odd way of kind of being cyclical in nature. The darling becomes the, you know, sort of the ugly duckling and then kind of turns back to becoming the darling. So I do hope that India over the next few years will be able to regain that position that it enjoyed from about 2000 till about 2009, even into 2010. And let's study, therefore, what has happened structurally to change that as to why in 2 years, rapidly, the Indian investment story has seen such rapid changes, and why the world is very wary, at least the investment world or the investor world, which is who I deal with, and two, how can that change, or will it change? And obviously we can go through the Q&A in that, but just some data points. In 2005, when really or 2004 to 2006, when really foreign investors flocked to India, which was also a sign of what was happening in the world at large. The world was awash in liquidity. Almost every growth story was being celebrated. India was very much part of that story, along with China and obviously the BRIC nations, till that music stopped, at least globally, in 2007. India kept going, in fact, and had a great opportunity in those 2 years from 2007 to 2009. And if you remember the headlines in The Economist or the Financial Times or the Wall Street Journal, everybody was celebrating the fact that this was going to be India's time in the sun, because sitting in India, we had escaped what was really a failure of the modern capitalist system around the world, fundamentally because of the way the economic policies that the government had followed, which in fact had been subject to criticism over the last 10, 15 years, but were suddenly being celebrated. So what went wrong over the last 2 years? A, we started believing our own bullshit. Please excuse my French. Two, corruption and crony capitalism has reached a point where it's very difficult to build any kind of business in India without subscribing to that. That's the sad part about the modern India story. Three, the politics and the hand-in-glove approach of the politicians, the bureaucracy, and the oligarchy, which is what I call most of the leading business houses in India, has reached a point where if you want to actually break through that, it is extremely difficult to actually get anything done. Most people want to take shortcuts. You know, growing up, we used to hear the term jugaad, which was celebrated. It was supposed to be sort of a mirror image of innovation. My submission to you is, jugaad is not innovation. Innovation is very different. Jugaad is taking shortcuts, the wrong kind of shortcuts. And that, unfortunately, has been celebrated in India and has reached a point where it is actually one of the most, one of the biggest things that's holding India back. Now, you might ask, what am I doing as an investor investing primarily in India? So, which is true. So the challenge is, but it's important to understand the risks when you go into India as an investor in India, because that is the only way you can structure around those risks or be cognizant of those risks so that you do not get into situations which are actually going to cause loss of either capital or mediocre type returns. India requires a key focus on execution. The biggest challenge is most investments that go into India, most opportunities that, for example, Roopa listed out in India remain on paper. They do not actually get executed. And so as investors in India, my recommendation, advice, and we practice what we preach as well, is that you have to be a hands-on investor. Being a minority investor, being a passive investor just does not work in India. It also doesn't work in most emerging markets, by the way. So this is not something that is very different from other major emerging markets. And I don't want to make this sound like I'm dissing India, which I'm absolutely not. I'm just pointing out the reality. There are great opportunities, but you have to tap into those opportunities. Your execution models need to be absolutely realistic, absolutely focused, and you have to roll up your sleeves and get down to it, because unfortunately most people are not focused on the execution. They are focused on selling the story, which is unfortunate. 2, you have to be prepared to deal with a lot of corruption, a lot of bureaucracy which hasn't changed. It's become worse, not better. And I feel that it's going to become much worse over the next 2 years till fundamentally it reaches a point where structural changes will happen. I think they will happen, but it will take some time. My hope is that the political churning that is obviously coming in 2014, and it will be churning, will hopefully emerge some solutions, because a lot of this is led by political leadership. And we have no political leaders, very few I would say, today. And the hope is that over the next couple of years, at least some new political leadership will emerge at the federal level, which will enable what certain states have been able to do to be transformed into the sort of federal landscape. 3, a lot of this is led also by sentiment, global sentiment, and sentiment turns on a dime. From, as I said, till 2009, India was the world's darling, and then suddenly you found in the last 2 years, as global sentiment has declined and people have had a flight to safety, combined with the Indian government's brilliance in scoring self-goals, that has resulted in global sentiment turning away from India. That will change, but it will also require fundamentally focus on what happens in the rest of the world. So if Europe and America find their feet, or the global economy doesn't fall off the rails, as is most likely over the next 2 years, India might see some benefit from that. But if things become worse, which they are likely to, and I'm a pessimist unfortunately, India will have its own challenges, because the Indian economy is not going to grow in isolation. So while I hope, Roopa, that we achieve 7 to 8% type of growth estimates, my bet would be it's more like 5 to 6%, which is still fine, because that doesn't mean that there aren't states in India which are growing at 10, 12%. India is like Europe. You have to focus on the micro, not on the macro. The macro always looks interesting, but the micro is where the opportunities lie. And I'll stop there and give it back to Suraj, because I think it might be more interesting to see where the audience is actually going with this. And
no, absolutely. Thank you. Thanks a lot, Sid. That was certainly, to say the least, quite provocative. So there you have it, the opportunities and the reality. So let's open it up. So feel free, if you can project loud enough, then speak from wherever you are, otherwise there's a mic here for you. You can address it to any of the panelists or all of them. Yeah.
Question for Sid. You talked a lot about crony capitalism, and then you talked about realistic execution. My question is, how do you reconcile the two without going into territory that you might not ethically want to?
It's very hard. It's very easy to step over a bright line that you draw for yourself. Firstly, the bright line has to be drawn for yourself. 2, you need to stick to it. And there will be instances that you're very tempted. And it is for you as an entrepreneur, as an investor, to have that bright line in mind and say, resist the temptation. And most days, it may result in getting up and feel like you're banging your head against a stone wall, which it does. But even stone walls give way. And I think that's really where the focus needs to be. It's not impossible. I didn't say it was impossible. I said it's very difficult.
Are there industries as an investor where you feel stone walls are slightly less stiff?
So one way of accessing the Indian market is obviously through the public markets, where you might say that even though you know what the underlying company might be doing, you're sitting 2 steps away, which many people do, and it's a more liquid market. And if you see the returns from the Indian stock market as an investor, from 2000 to 2013, it's the best returns in any major economy in the world, about 200% plus, as opposed to the Shanghai Composite Index, which is about 55%, and most major developed economies, which are 0 to negative. So you can say that could be a way of accessing the Indian market. In terms of investment in actually Indian companies, I think almost everywhere that you go in India, there are different states which have different levels of crony capitalism or of involvement of the kind of permit license Raj that existed in the 90s, which has come back in a significant way in different adapted models, but it's still there. And I think a lot of it has to focus on just working, being focused on what you're doing on execution, and thinking about how you can avoid getting involved in a lot of the stuff that unfortunately exists in the country. And as I said, it's not easy. It will be difficult, but you have to stick to your guns. And people have. It's much more difficult. You will see opportunities, notional opportunities go by because you can't participate in that. And I'm not saying anything that the business community in India is not saying. The Tatas, Ratan Tata is on record saying that the reason why they're looking outside India and 60% of their businesses are in India, because they have to add another about 800 basis points to their return hurdle because of the nonsense that goes around in India, and they're just not willing to do that.
Let me actually, this is an interesting point that Roopa deals a lot with international investors and investment banks and others, and as does Merin in terms of foreign businesses trying to invest in India. So what are your perspectives?
So, at the outset, I would like to say that I don't believe that, the hubris around India that existed, say, a few years ago was well-founded. Neither do I believe the pessimism that is being articulated and talked about in so many quarters today is well-founded either. I think the truth is somewhere in between. I think, as Sid rightly said, India is not an easy place to do business. I think no one ever said it was. It wasn't ever easy. I don't think it's that's going to change overnight. But I disagree with Sid in that there's no money to be made in India. I think there are enough people, you talked about the returns that the stock markets have given, for example. There are enough people that have made money by investing in India. There are enough firms that make money in India through the ethical route. Now, again, as Sid said, I don't think that's always easy. But there are sectors which I believe are less dependent on government policy. I think if you are in the heavy hitting investment sectors like infrastructure, etc., where the dependence on land, on government or policy for acquisition of land, environment clearances, linkage to fuel supply sources, etc., is a must of doing business. I think there is no doubt that it gets very challenging there. On the other hand, you have the other set of industries, which are the newer industries that have come up, the ITES, or industries such as ours, for example, which are not very dependent on government policy or landing up at North Block or landing up in front of a bureaucrat or a policy maker, and I think that things are much easier there. So I think, I think the truth really lies somewhere in between. In terms of can it be done? Can you do business without getting sucked into the morass of corruption, crony capitalism, and the like? I would agree with Sid. I think it's hard, but I think it's not impossible. And if you take the example of our firm, when we started off as a company in the late 1980s, early 1990s, nobody believed that it was possible for a company to exist in India where opinions could be truly independent. everybody said, oh, come on, one phone call from here and one phone call from there, and you will change your ratings and change your opinions. Notwithstanding that, I think their ratings have changed on governments, ratings have changed on government-owned enterprises, and I think the market itself has been very wise in realizing to let us well go. So I think there are examples of companies which have proved that doing well can go hand in hand with doing what is right. Again, not easy, but can be done.
Can I just point out, I didn't say it's impossible. We've made money. So, working in real estate primarily and retail, which is capital intensive, so I said most people have not made money because they have not been focused on the risks that go along with investing in India. So just pointing out.
So Merin, how do U.S. businesses think about this? Walmart's gotten into massive trouble in Mexico on Foreign Corrupt Practices Act. So it is illegal for U.S. firms to do any of the things that Sid points out. How do they deal?
U.S. business holds itself to the highest standards, both regulations-wise and in terms of transparency abroad. It's relative to other. The U.S. does have a global reputation for this, and
so this is being taped.
Now, India is a prime example of the collaboration between the government and the private sector, and as Sid had mentioned, it is a hands-on approach that you must take. Committing business and investment in India. That being said, the focus, once again, it shouldn't be transactional in nature. It should have a trajectory, long-term trajectory, willing to really invest time, patience, energy. And I think the key link to being successful in India is at the onset, it's a structural, methodical analysis where you actually connect with the political leaders at the state and local levels. I think the central government has given an extraordinary autonomy for states to increase investment, and a lot of chief ministers are really capitalizing on this. And so I think any sort of investment must factor in that relationship. And that being said, I could give a laundry list of examples, but the government is looking to partner with businesses, and they are very fond of U.S. businesses in particular because of the standards. And so once again, it's not a short-term investment. This has to be kind of a long-term trajectory. So,
what was the question?
So which states of India do you feel have gotten economic and regulatory reform correct, or at least as correct as it could be, and which of those reforms do you feel would actually be executable on a national level?
Sure. I'll give a great example. Chief Minister Chauhan from Madhya Pradesh actually recently came to Washington, and he has really changed the game in Madhya Pradesh. First of all, you have a state that's inland and not previously known for international business. He has now attracted so much international investment through his administration. And some of the examples of what he does. The single window clearance process. One of the biggest issues in investing in India is the time it takes to acquire all of the necessary clearances. That being said, the government of India is very methodical in those clearances because they do have to protect the national security interests. Now, the chief minister personally reviews all foreign applications for investment. He guarantees a 3-day turnaround on all necessary clearances, and if there are any issues, flags them. And if the bureaucracy holds that clearance beyond that 3-day window, there's actually a penalty assessed to the administration itself. And so that's one example. In addition, he personally takes time to go out to all of the Tier 2, Tier 3 cities, looking for opportunities, building those knowledge corridors I've mentioned, really looking at opportunities, but taking in the input from international investors on what the state needs to do to enhance its attractiveness. And so, I know that clearance process is one of the big issues, and that's one of his direct approaches to that. So, if that answers your...
Can you give his name?
Chief Minister Chauhan.
Shivraj Singh Chauhan.
The question back there?
This is related to the point Roopa made, but I would like to hear from other panelists also. The size of the bond market in India being small, what are the reasons? And especially in context of the work that you've done in the small and medium sector. I'm curious to know why companies don't raise bonds, given that they probably have to, they're growing fast, so the equity returns will probably be higher. So bond would probably be a cheaper way of raising money. I'm curious to know why the bond market is small.
considering that we were a firm set up as an India-focused credit rating agency, we are waiting for 25 years now for the bond markets in India to happen. So the subject is indeed very close to our hearts. I think there are several reasons why the bond markets in India haven't taken off. They have to do with regulation, both related to the issuer side and relating to the investor side. As far as the issuer side is concerned, I think in the last 3 to 4 years, several measures have been taken to make issuance of bonds easier for you as an issuer. Consider this, until very recently, if you had to issue a bond in India, the amount of paperwork that you had to do was equivalent to doing an IPO, making an initial public offering. So it was indeed extremely onerous, you want to take advantage of an interest rates and decide you want to access the bond markets at 24, 48 hours notice perhaps, and that was virtually rendered impossible by the amount of bureaucracy and paperwork that went around the whole issuance process. There were issues relating to taxation, trust structures, etc., which came in the way of securitization, and a whole lot of issues relating to that, which again I think have begun to be addressed one by one. If you were to ask me today, I think the primary constraint, and there are several reasons, but I think the primary constraint that remains today for a robust bond market to emerge are two. The first constraint is the shackles on Indian investors. So the largest Indian investors who have long-term money in India are the pension funds, provident funds, and the insurance companies. And there, the investment norms are extremely restrictive. Consider this, the single largest investor in India, the Employees Provident Fund Organization, which has a corpus of about $40 to $50 billion, is today investing only in 7 private sector companies. That's it. In bonds of only 7 private sector companies, and these are more like the banks and financial institutions. So the restrictions on insurance companies exist as well. They aren't allowed to invest anything in any paper which is rated below AA by domestic rating agencies. So I think that is the big constraint. The other big constraint is the way lending is structured in India. So if you look at it again, today 11% of the banking system's exposure is to the infrastructure sector, which is long-term loans. But banks are funded by short-term deposits, so there is an inherent asset-liability mismatch, and it would be ideal if after 2-3 years of project commissioning, the bank was able to get the loans off its books and sell them off to an insurance company which had the largest longer-term funds. Now that unfortunately again is rendered impossible by the fact that it's very difficult under the legal system to convert the loans into securities which can then be sold off to the insurance companies, for example. So these are, I think, the 2 biggest impediments today.
Can I add? Yes. I just wanted to add a tactical point here. So this might be one of the areas that I actually agree with Roopa. So the development of a bond market is definitely one of the things that's holding the Indian economy back. But perhaps the reason that a lot of people do not necessarily look at the bond market is, at least in certain industries, and infrastructure industries and real estate being one of them, is that equity is treated as debt. So if you asked a large real estate company if they're bringing in an equity investor, in their minds, whatever the paperwork might look like, in their minds they're not parting with equity, they're parting with debt, or they're sort of structuring it as a debt instrument, and that's what's happened. So that's one. 2, a lot of the issues related to the structural reforms are probably some wise people in the government do think that it is better not to let the big government institutions, the insurance companies and the pension funds probably get into this side of the market, because you might find that what's happening in the public sector banks might actually start happening in those companies as well, where it's one of the best kept secrets that effectively a lot of the public sector banks are lending to companies that they really shouldn't be lending to for reasons I won't get into. And most of those loans are bad loans in any case. So, which is no different, by the way, from what is happening in the rest of the world and in the US, where loans are just being kicked down the road, the can is being kicked down the road. If the banks actually had to recognize NPAs, the banks themselves would be bankrupt.
Yep.
Hi, I'm Kanan and I'm a portfolio manager working for Citizens Bank, and my question is for you, Sid. So your point about corruption hit home with me. So as an individual, I'm looking to invest in India on a business idea in the next couple of years, but I am on the fence for the very same reason, the corruption that you mentioned. And I think that not only corruption, but there is, apart from the capital that you're trying to invest in India, the other thing that hurts the investment community is you need to have someone in the political arena that you need to know, or in simple terms, like you need to have like political influence, which means that you need to know somebody in the administration just to have your paperwork moved or get the approvals or the permits that you needed or something like that, right? So what do you think that the solution is? Like I know you mentioned that the corruption is what is hurting the investment community and it's going to change at some point. But what do you think is the solution? And what I think is that there needs to be some kind of a revolution that needs to happen, or some kind of an unrest, which is what is the solution to that occurs to me whenever I think about this corruption. So what's your take on that?
How have you solved the problem, Sid, yourself?
Well, those are
multiple. Because we can talk about the larger political solutions.
Those are multiple questions, and I think there are 2 or 3 things here that I would like to react in. I wouldn't trade our democracy for anything, so let me start by saying that. Whatever its problems, whatever its issues, I think that is something that is, at least to me as a citizen of India, it is very important. And there are problems that exist anywhere in the world. There are different kinds of problems, but I think having that form of government with its own problems, 2 steps forward, 1 step back, as Roopa said, which I agree with, I would rather have that than anything else. So I enjoy my freedoms and I'm very happy to be in India. 2, the nature of the problems that you suggest are often amplified as well. So I would encourage you to get down there, because some of the things that you're afraid of may not be realistic. You're sitting 10,000 miles away. So don't be a suitcase investor.
I do visit India every year.
Yeah. Don't be a suitcase investor is what I call people who get on in New York, land in India for 2 days, try and invest and come back to New York. It's not possible to do that, which is what I said, focus on the execution. You have to be on the ground, you have to be in the weeds, and you have to be working your investment. 3, I do not believe it is necessary to know somebody in the political system to get things done. In fact, it's better to stay away from it and keep a very low profile so that people in the political system don't get to know me. And I think that's the thing that most people miss, right? If your business, if your primary business is making good risk-adjusted returns, you should focus on that and not focus on being in the newspaper every day.
Sure.
Can we move on? We probably have a lot more people wanting to ask questions. So we can take 5 more minutes. Okay, so yeah, the person in the middle, go ahead.
So does CRISIL have, or does it plan to operate in Africa? And from the slideshow you showed, it seems to have very similar characteristics in India, in that it has favorable population demographics, increasingly important role that youth has played, and it's a highly developing economy, as well as that is fragmented.
So one of the really small areas of work that we do in terms of, from a business perspective, but I think from an impact perspective, and creating an enabling environment in terms of development of capital markets is concerned, is the work that we do in the policy advisory area. So we work with governments, both in India and in emerging market countries, to create enabling frameworks for the development of infrastructure. So for example, within India, we work with the Andhra Pradesh government to draft India's first public-private participation legislation. We are working with the government of Indonesia to come up with Indonesian Credit Guarantee Fund, for example. So these are examples of work that we do in emerging economies that create an enabling infrastructure, enabling environment for development of infrastructure and the capital markets, debt markets in particular. There is work of this nature that we've done in several countries in Africa. In South Africa, for example, we've developed with the government of South Africa the first renewable energy trading certificates trading system to enable utilities to meet their green energy commitments that they have, for example. So there is already a lot of work that we do, particularly on the policy side in African countries. As a rating agency, I think no immediate plans to really get into the African market.
Can you comment on the growth of asset management industry, specifically highlighting pension funds mutual funds and retail investors, and all this is over the next 5 to 10 year horizon. And do you see any irrational element in the equity markets growing, or do you think it's becoming more rational going forward?
So there are lots of questions in that one, right? So let me begin with the asset management industry. I think the asset management industry, has been through ups and downs. The mutual fund industry in India particularly has been through several ups and downs, and there's been a saga of new regulation coming in the last 2 to 3 years, which the industry has been struggling to adjust to and cope with, right? However, your question is from a longer term perspective. And concomitant with the growing proportion of the affluent Indian or migration of people into the middle class, I think the mutual fund or the asset management industry will only grow. The demand for products, for investment products, for loan products, etc., is going to be a big driver of financial markets. So I think that over a longer term, and which is why you have already 30, 40, I think at last count, if I remember right, there were 36 fund asset management companies in India, many of them foreign as well, right? So I think everyone is coming in because they are seeing the longer term potential. Insurance is another example where people have come and planted their flag again, looking at a 20, 30-year horizon, because as your population becomes more affluent, as the middle class grows, the demand for these products will grow. What was your second question?
How irrational are the Indian markets?
I don't think I'm the best person to comment on that. Sid probably is a better person, but I would say that if you look at again the way the markets behaved in India, again the whole India story, I believe that both ways, that both the hubris that we saw in the last 2 to 3 years, as I said a little bit earlier, it was overhyped, and I think the pessimism that is being touted today is again overhyped on the downside. So I think in both ways we've tended to overreact, is my view.
I think I'll again agree with Roopa. We don't have more things that we agree with on. I think India as a market needs a long-term orientation. You can't be a short-term investor here. So a lot of people who have tried to come into India with 2 to 3 year horizons have burnt their fingers very badly. They've also, for being that short-term horizon investor, have got into things that they shouldn't have. So it's a combination of two things. The Indian market has grown substantially. The industry that I primarily invest in, particularly real estate, to give you a number, in 2005, all of grade A occupied office space, third-party occupied office space in the top 7 cities in India was 60 million feet. Today, that number is 320 million feet, same 7 cities. The biggest office market, or the office market that had the maximum absorption last year, was not in the US, was not in China, it was Bombay. So obviously that'd be a proxy for growth of business and services, which it is. You can also imagine that it's not just the real estate market, but there is demand from underlying companies, both international and domestic, which is driving that. So 2-3 points. One, you have to have a long-term orientation when looking at the Indian market. A. 2, there are all kinds of risks. You have to structure around those risks. You have to be aware of those risks and make sure that you're not going in with all guns blazing and being a cowboy investor or a suitcase investor. I think you need to focus on this risk. There are ways to structure around it, and that's the skill that you bring as an investor, hopefully, or as an entrepreneur into whatever is done, which is no different from the rest of the world, different types of risks. 3, one of the most important things about India, which Roopa said, we tend to overreact on both sides, which I completely agree with. If you look at the covers of The Economist since 2005, which I track closely because it's an editorial magazine, reflects sentiment, you'll see how the covers reflect the sentiment which is going on one extreme to the other. And neither of those two extremes are true. Nothing really has fundamentally changed in India since 2005, structurally or otherwise. There has been minor movement that the Indian government's made. A lot of it is actually Mr. Chidambaram, who's actually an alum of the school as well, has done some fantastic things. which are not necessarily that amplified, but are structurally very sound. And there has been movement made. But what's happened is really sentiment has changed, which I talked about, and sentiment turns on a dime, and it can turn again very soon, and it will probably. Lastly, I'd like to end with this small sort of quote that I can give you. You know, the pessimist complains about the wind. The optimist expects it to change. The realist adjusts the same. So that's what I'd leave you with. Would you like some closing remarks? Very well said.
Yeah, very well said. So on that note, thank you all so much for